Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Welcome, everyone, to this panel on navigating the uneven global recovery. We have a wonderful lineup of panelists in this session who are all going to share with us their thoughts on what kind of challenges the very uneven pace of the global economic recovery poses, especially from an investor perspective. Without too much of an introduction, what each panelist will do now is share with us their introductory thoughts. How are you looking at the global economic recovery right now? What sort of opportunities is this opening up? And looking specifically at this theme of a very divergent economic recovery, what are the potential hurdles that you see in terms of market performance, in terms of capital going from where there might be an excess of it to where it's needed the most, and how are you navigating these potential hurdles? So maybe in terms of the introductory comments, Julia, if we can start with you, what challenges from this very uneven global economic recovery?
Oh, thanks, Razia, and thank you very much for inviting me to join this panel today. So what we're seeing is really diverging recovery prospects. We have developed market economies booming. We have emerging market economy instead seeing their growth momentum slowing down. This is, of course, because in part of China's policy normalization, the COVID infections rising again in a number of countries. We heard the news from Vietnam, but also the move of the Copa America from Argentina to Brazil, for example, on the back of those COVID cases numbers. And of course, a very different pace of vaccination rollout. I was listening to the radio just this morning. WHO was mentioning how, for example, Africa has only received 2% of the global jobs available out there. They were making the case of Nigeria getting 4 million doses of vaccine from the COVAX initiative. But they were also referring to something really worrisome, such as Nigeria itself only administering only 2 million of those doses because of reticence on the part of the population to take up that vaccine. So also some challenges with not just the availability of vaccine, but also the willingness of people to take them. Ultimately, I think the convergence in EM-DM growth hinges very much on progress on vaccination rollout. To be sure, we've had positive signs of a break between cases and infections and mobility. So you're seeing much more localized lockdowns, for example, also in a number of emerging markets. That will help keep up the recovery in some of these economies. But all of this happens, of course, against the backdrop of rising concerns around inflation, particularly in developed markets. In the US, we know that federal officials have gone to great lengths to say that they see the rise in inflation we've been witnessing there as temporary. They're willing to look through this in order to support this recovery. But I think it's fair to say that the pace of the recovery we see in developed markets and the speed at which that output gap has been closing has really surprised us to the upside. And with stimulus continuing in many of these developed economies, of course, that brings about the risk of a policy error that could lead to some premature tightening. And to be clear, EM as an asset class will feel this. In the short term, we need to be prepared for more episodes of market volatility. That's what we see for the remainder of this year. In the medium term, that's more of the question, what should EM do? I think EM should take this crisis, as they say, as an opportunity to do things differently. Of course, it's very challenging at a time when there's also very difficult sort of humanitarian crisis going on, to be sure. But taking this as an opportunity to reprioritize fiscal expenditures, to close some of those gaps, to reduce some of those gaps, would be very important. So far, I think we've been somewhat complacent with that famous R and G equation, with R being rather low and hence giving us the impression that that was going to be sustainable for a rather long time. We're seeing the first cases where this is no longer the case. And so what can they do? Of course, the conversation around debt relief is very much front of mind for some of the particularly frontier economies we're looking at. I'm hoping we'll get to discuss that later on. But also EM and frontier markets specifically can really take advantage of this time as especially of that pool of capital that is interested in supporting more sustainable recovery, more sustainable growth paths. And speaking especially of ESG-focused investors that are keen to deploy money in this effort. And of course, the innovative tools now at these markets' disposal, new sustainability-linked bonds, green bonds, formats that we're seeing, but also more discussions with international financial institutions on how best to support this recovery. So we have some tools, but there's a lot of work to be done in the medium term, that's for sure.
Thank you, Julia. So a clear challenge for emerging markets. Everyone's expectation is that because developed markets are growing that much faster, seeing a more robust recovery, the underlying COVID trajectory and the pace of vaccine success has a lot to do with that. It's not exactly a clear-cut horizon in terms of the outlook for emerging markets, but some really interesting points that you raised there, I believe, in terms of this could also be the opportunity for reform in terms of differentiation of different emerging markets. There's perhaps too much that we had become complacent about pre-COVID, and the challenge post-COVID is going to be about accelerating that reform. So staying with that theme and moving to you, Yerlan, in terms of the outlook, your thoughts on inflation. Do we have a great deal of comfort in terms of how much longer we might be able to count on this very accommodative policy remaining in place? What sort of a time horizon should we be looking at in terms of when this starts to become more of an issue for emerging markets? And if you could also touch on some of those themes that Julia raised, this could be the opportunity for accelerated reforms. Some EMs may well perform better than others. How are you looking at this situation?
Yes, absolutely. Taking on from Julia's comments, especially on ESG side, we've seen a significant interplay between the elements of the ES and G, and specifically between S and G. So we always knew that the governance plays a huge role in making the countries attractive for investors, but on the social side, we didn't really see how much of that can be of an element now in the post-pandemic recovery. We're clearly seeing those countries which have better social cohesion, better setup in terms of fighting inequality, going to recover quicker compared to the countries with the larger inequalities and a larger social gap. So I think this is a very, very important point that you raised, and the importance of the social element and investing in the social element has become even more important. We've seen the sustainability-linked bonds and social bonds coming out fairly recently, tackling specifically those issues, and investors have been very keen in supporting those. So I think this is a huge theme for us going forward: governability, the competence of the administering of the social part, administering of the governance generally will play a major role now in how investors look and assess emerging markets. Going back to your earlier question on inflation, clearly inflation has been going up in emerging markets already ahead of the inflation trends that we've seen in developed worlds. But of course, the biggest point here for emerging markets would be how liquidity and how the price of money will work out coming from the Fed. And I think expectations have now shifted that this summer we will see a certain shift in the thinking of the Fed and towards more aggressive discussions on tapering and more aggressive discussions on the path for the interest rate normalization. And that, of course, in and itself is creating already a reasonably strong negative sentiment towards rates. And in emerging markets, we have to face it. Our internal emerging market rates have been going up already, but if we do see the rates in developed markets going further higher, I think it will be inescapable for us to have an adjustment to that new environment going forward. So I think this is a key question that we're facing ourselves. In terms of horizon, as you asked the question, we're looking at 12 months where we probably will see adjustments to the interest rate environment in the global markets. So continuous pressure on duration from that perspective. Although, of course, we don't think that this is going to be a devastating blow, as we are seeing the recovery from the pandemic in emerging markets in the second half of this year. What Julie was mentioning, vaccination pace is starting to take place in a very major economies in emerging markets. So by September, October, we shall see the beginning of the positive effect of that vaccination campaign in major economies that will help us to start recovery going into the next year. So I think this is where we are quite positive on the prospects of emerging market growth. But in general, of course, the uneven nature of recovery, as Julia mentioned, is key for us to assess how quickly each individual economy will recover. And of course, the key biggest point for us will be also the amount of stimulus the countries themselves can provide to their economies to really stabilize for that period of recovery until we're going to get the vaccination going in those countries.
Thank you, Yarlan. So you made some very important points there. Not only are we looking at almost the certainty of there being Fed tapering at some point, and we all know what this is likely to mean. We can't ignore the pressures, how emerging markets are likely to react. But alongside that, there could be a very interesting timing issue in terms of when we really see a more full-fledged, robust economic recovery in emerging markets themselves. And I guess the key question here must be the extent to which one is able to offset the other. So maybe turning to Martin on this point, how are you looking at this? Would you be that much more enthused about emerging market growth reasserting itself? Is it going to happen at precisely that time that we're seeing that much more happening around the tapering conversation? Is the growth going to be enough to withstand the pressures of tapering?
Thank you, Razia, and hello, everyone. Of course, we are in a situation that we are facing unprecedented global recovery that has not happened for decades. And of course, as you mentioned and the speakers mentioned, it's very uneven. So of course, it will open some opportunities to play the countries that are in a better position versus the ones that are in a worse situation. But generally speaking, globally, what we are considering right now is the side effect of this growth impacting emerging markets. That being inflation, that being the risk of tapering. But I think more medium term, we should ask ourselves how this recovery differs from the previous recoveries, because there have always been uneven, they have always been laggards. But now we have a situation where actually there is a policy change between the US and China. And US is not so much trying to slow down China, but is trying to join China in this growth race. It's actually trying to outgrow, and the President Biden's stimulus, infrastructure stimulus, they're all aimed to create and push the potential GDP in the US. And in many aspects, US is already taking the role of China being a marginal price, let's say, price setter, or let's say marginal buyer of some sort of commodities. And the more we talk about the green push and green transformation, the more relevant that becomes for certain commodities. So when we have a dual engine of growth globally, I think that opens the room for many opportunities, because we tend to think very quickly about the risks, inflation, tapering, let's say the gap between DM growth and EM growth being in favor of DM, especially in the second quarter this year. But what it can happen in the medium term is that it opens a new possibilities and new opportunities for all the emerging markets. First, there will be more balanced global growth, more balanced commodity demand. Also, the EM countries can position themselves to be in the supply chain, whether it's for the US, whether it's for China, whether that means that some countries will benefit immediately from, for example, the Biden push, that being Mexico, that being Brazil, that being some Southern Asia countries. The other will continue with China, and basically that opens the new toolbox for these countries that they can play in the future, and that's on the growth side. But of course, on the financing side, there is also a change in the global landscape where these superpowers are actually, in a way, competing to align their friends and partners and providing the financing. So it was historically the Bretton Woods institutions, the IMF, the World Bank, providing the financing to the countries. IMF more in the case of balance of payments problems, World Bank more on the reducing poverty, etc. But now, of course, China stepped in the recent years. And I think now what we are seeing is parallel initiative happening, whether this is being G20, whether this is being the common framework, increased SDR allocation by the IMF, and also China initiative, the regional partnership on the trade, Belt and Road initiative, etc., that opens the whole new possibilities for EM countries on the financing side and on participating in this global growth side. So to me, this is the biggest change that we are witnessing. And of course, in the short run, we will worry about inflation. We will look at the rate sensitivity of these countries that can actually put the frontier markets in a very nice spot. And I think we're going to discuss that in more details. But to me, this whole new world order, if you will, opens room for emerging markets also to reform, but to push this growth story a little bit farther. So I think actually I'm taking the glass half full point of view on that.
Thank you. And perhaps that's an important reminder. So much of the narrative around this has been around, inflation fears. What should we be making of them? The inevitability of higher interest rates. This is coming at a reasonably bad time for markets that still have significant COVID-related constraints, the uneven pace of the vaccination rollout. But what you're saying is there is actually great opportunity in this, DMs as well as EMs growing. This could certainly lift prospects for everyone. And perhaps it's misplaced to think that much around the inflation story and not to focus that much more on the growth story. Christian, would you agree? Or should we be a little bit more worried about this?
Well, I would agree that the growth story is the dominant story. And as Marjan has explained, there is a change in American leadership, and the new administration is trying to outgrow China instead of trying to bring China down. So that changes a lot of things. It also raises the question why anyone should be investing in emerging markets when they can buy US equities. Yeah. So it's a great story for the world, but it's also a challenging story for us. I personally, in this uneven recovery that we're seeing, from the perspective of a European asset gatherer and asset manager, I see two challenges. And there is an inherent tension between those two challenges. The first one is one that has already been mentioned by Julia and also by the colleague from Amundi, that is ESG integration, deep in ESG integration. From 2022 onwards, every financial advisor in Europe will be required to inquire about the sustainability preference of their retail clients. And that means that a lot of the new money that we gather will flow into sustainability-themed funds. We've done some test interviews amongst our clients. Turns out that 60% or so prefer sustainability-themed funds, even if it entails a loss in performance. And when I look at our trailing 12-month inflows, more than 70% of those are flowing into sustainability-themed funds. And we have a very strict definition of sustainability. So for us as asset managers, that means We have to relearn our craft. And I mean sustainability and the ESG integration, not just in the sense of following guidelines and exclusion lists, but deep integration of ESG aspects into our investment management, into every single investment decision that we take. And for us as emerging markets investors, I think it's clear that something like the Amato transaction in Mozambique, if it repeats itself, it will be lethal to the reputation not only of the investment banks involved, but also of the asset managers involved. So ESG integration will become a very important part of our day-to-day work. And the old approach of just holding our noses when we invest in emerging markets is no longer viable. So that, I think, is the first challenge that we're facing. The second challenge that we're facing is the fact that we not only have an uneven economic recovery, we also have deeply uneven interest rates. We have an abundance of capital in the north, which is, visible in the deeply negative real interest rates that we're facing in continental Europe and the United States. And at the same time, we have a lot of scarcity of capital in emerging economies. If you look at the work of, for example, one of our competitors, Asia Debt Management, which raises money 15% yields in all across Asia in private transactions, these are rates which are unheard of in the north. And the challenge that we as asset managers are facing is how can we channel that money from the north to the places where it's needed in the south. And this is where the tension comes in. The fear that I have is that the greater focus on ESG integration will lead many investors to turn away from emerging markets because they see it as too complicated. ESG factors are negative, a lot of corruption, bad E values, bad G values, and they may just turn away from it by following a naive best-in-class approach. And that would be very detrimental to the future of the asset class. And I must say, the efforts taken so far by the official sector have not been helpful. If you look at the spread divergence between the DSSI eligible countries and the countries that are not DSSI eligible, or the common framework eligible countries, and the ones that are not affected by the common framework, it is widening. So what we've seen so far from the official sector is an effort that is driving capital away from the places where it is most needed. Yeah. So I think the way to deal with those two competing challenges is use of proceed bonds. Yeah. So I think that there needs to be greater emphasis on green bonds, greater emphasis on sustainability-linked bonds, and also an element of investor education. That there are a number of countries out there, in Africa, for example, I would mention Senegal or Ghana, which, given their level of economic development, have actually done a lot to meet those ESG standards, and they should be eligible investments. So maybe just one last word. In order to deal with those challenges, we need partners. We need strong partners that are committed to the asset class. And in that sense, just since we're on a Standard Chartered call here, I'm very happy to see Standard Chartered being not only committed, but increasingly committed to that asset class. There have been some very high-profile hires, Sharat Desai, Mirko Stiglic. I see Standard Chartered on the banking side being active in the G20 world with SPV proposals to mitigate the problems that are inherent in the DSSI approach. And we need those partners, such as Standard Chartered. We need a healthy amount of competition, and we need partners such as Standard Chartered, which are committed to that asset class.
Thank you, Christian. And that's certainly very good to hear that the efforts so far are appreciated. Thank you for raising those two key issues, the one on ESG integration and the other on the multilateral response to the crisis so far, whether it's really done enough to bring more capital to those locations that need the increase in capital. It's one thing to be talking about the very uneven nature of global growth. I think quite another to realize that perhaps what was intended to be a beneficial multilateral response, what can be done around the lower income countries that were especially hard hit by this crisis, has inadvertently helped to complicate the investment environment for a lot of potential beneficiaries. There's been a great deal of uncertainty around that. I'd like us as a panel to take those two issues, maybe starting first with the multilateral response to the crisis and what could have been done better, and then if we can really drill down on what needs to happen for more effective ESG integration, what would be on the wish list for investors. But before we go there, just a reminder to everyone listening to this session, you do have the ability to put forward any questions that you have to the panel, so please do enter that into the chat function. That will be made available to us. But first of all, on this issue of the multilateral response to the crisis so far, and maybe Julia, starting with you, I know you've looked at this from the outset. It impacted a lot of low-income countries, sub-Saharan African economies in particular. The uncertainty that was created with initiatives like the DSSI, the lack of clarity around what would be involved, has that uncertainty now faded? Do we see a more clear-cut horizon, or is it still a problem?
Well, I think I'll take the, just like Martin did earlier on, the glass half full type of approach to this. Inevitably, some of those initiatives did create a good amount of uncertainty, particularly, for example, at this time last year, at the peak of the pandemic, a lot of discussions around blanket initiatives around debt relief, back and forth between international financial institutions and investors. A lot of uncertainty was definitely created, and particularly African asset prices, but not only that, broader frontier markets really felt the heat there. I think it's important to recognize that international financial institutions did step in to provide much needed support at the time that this was required. If you look at the 51 billion in support, in direct financial support that the IMF provided last year to emerging markets in general, about 19 billion of that went to Africa. If you look at the subset of the 31 billion of emergency relief, only type of disbursements that were given out by the IMF, again, 50% of that went to Africa. So to be sure, they did step up when the help was needed. They did come through alongside the G20, obviously, with the SSI initiative, which fell a bit short of expectations on the part of investors and created that uncertainty we were referring to earlier, particularly because it resulted in just very modest take-up and lack of clarity around the terms that were going to be applied. Now, that initiative has been extended, but alongside it, we've seen a couple of other initiatives coming through. Firstly, as was alluded to, more recently, the proposed increase in SDRs, with the proposal most recently by President Macron to divert a portion of the 650 billion specifically to needed nations such as African nations. That would help boost reserves in a number of countries. You have the outliers of Zambia, where you get an 85% boost, obviously from a very low base. You'd get a boost of around 20% for the Ghanas and El Salvadors of this world, but around a more modest 10%, 7% for most other African countries like Kenya, Nigeria, Cote d'Ivoire, and so on. So that alludes to the fact that some help is coming, but arguably more could be done. The other initiative is that, of course, of the common framework, which effectively establishes a way for countries to approach the IMF, get onto a program after they've carried out a DSA, and use that as a basis for discussion to approach other creditors, including the private sector, to get comparability of treatment in a framework of debt relief, if you like. Now, that means that effectively the private sector has been listened to some extent when it asks for countries' situations to be approached on a case-by-case basis. It is also, however, nothing really new. I mean, this is basically Paris Club on Evian terms, which happened about 20-odd years ago. So we're back to those kind of discussions, if you like. I guess a number of investors have taken the common framework and the case-by-case basis solution as a positive in the short term, because, of course, As investors, we all like to get paid back on the investments we make, and our clients as well, given that it's our fiduciary duty to do so. At the same time, I would sort of use a word of caution in saying that ultimately, if we look at a medium to long-term perspective, this is an issue that we need to resolve. There is clearly a debt issue that is coming up. And we've got a number of ways to resolve it. And we've got a number of actors involved in this discussion. We've got countries that, as we were saying earlier, need now to take this opportunity as a way to do some of that fiscal reprioritization we were discussing, to channel resources where most needed to support sustainable growth in the long term. We also have international financial institutions that have done a fair amount, but could arguably consider other options, such as the fact that they've been relatively reticent, for example, on leveraging their own balance sheets to provide the example of partially guaranteed support to countries such as the famous Ghana partial guarantee issue. If there was a pipeline of that, it could be easier to price such instruments. It could be an option to support these countries to have steady access at affordable terms to international capital markets. And last but not least, the issue of innovation I was talking about earlier, and that Christian, of course, referred to. Use of proceeds bonds. They're also a new channel to get money to the right places. And as investors, we very much support that. Ultimately, I think we have a number of tools. We need to get the willingness around that. I often make the reference to the approach we took in Nigeria about 15 years ago when I started my career as a civil servant there. We got that relief from the Paris Club. And part of that deal was to use $1 billion worth of money we would have spent in interest payments and put it in what we called a virtual poverty fund, which was a system to then tag in the budget this $1 billion and get it to be sent to education projects, health projects, other community-related support. All of that was properly tagged and monitored, thanks to capacity building, for example, from UNDP. That was not an isolated case. You fast forward 15 years and you see Mexico doing the same in their sustainable bond that they issued in September 2020, with a much improved set of data, much improved way of monitoring the way that proceeds are utilized. So it is by all means not perfect, but I think we have a number of tools as an international community that we can use to support these countries on a more sustainable growth path.
Thank you, Julia. So the theme of what more multilaterals could be doing, especially as regards the demand for much more ESG integration, I think this could fit together very nicely. The question to the panel, and feel free to jump in, anyone who wants to take this. Julia had raised this issue of, are we still concerned around the coming debt crisis, if it is going to be one? At the very heart of this issue of looking at what's happening to global interest rates, the consideration of which markets might be more vulnerable to that. Is this going to be sufficient to tip some over, or is that not the correct characterization at all? So maybe a question for the rest of the panel, and feel free to jump in, anyone who has strong thoughts on this. Should we be concerned around what is happening with EM debt loads? Are some countries more vulnerable than others?
I mean, I'd have two points on that. I mean, first of all, there are a number of cases we need to deal with immediately, and it's a limited number of cases: Zambia, Laos, Honduras, possibly Sri Lanka. Yeah, so these are countries that obviously need debt relief, and there we need to find a solution to that. And it's not acceptable for us to demand bailouts of private creditors. We need to take haircuts, as a private sector. The more relevant question in my mind is, how can we move to a situation where we avoid those incidents in the future? And I think that emerging markets in general have made great progress over the last 2 decades in better aligning their payment obligations with their payment capacity, which is what is required in order to avoid sovereign defaults, principally by moving into local currency debt. Yeah. So the rise of local currency debt markets has greatly contributed to a decline in default risk because tax revenues tend to be in domestic currency, And if you then have liabilities in domestic currency as well, you avoid the currency mismatch, which is typically leading to defaults, as we've seen in some of the sub-Saharan African countries today. I personally think that over the medium term, we can take greater steps in better aligning payment capacity and payment obligations of emerging market sovereigns by moving into state contingent debt instruments. Yeah. So there are a variety of those instruments out there. David Lubin has recently published a paper at the Chatham House about that. We've got these catastrophe bonds, which are well accepted already in the Caribbean, where countries can buy insurance against hurricanes. But I think that we can also move towards more symmetrical instruments, which means aligning interest payments and also principal payments directly with nominal GDP in domestic currency. So that sounds like a big step. And there are a lot of very bad experiences with that. I will just remind people of the Ukraine GDP warrants, which are a wonderful deal for any investor and extremely detrimental to the issuer. When they were issued, the central bank governor didn't know what he was signing up to. He had to ask investors to provide him with a spreadsheet on those obligations. Yeah, so that is not the way forward. Those asymmetrical instruments. But I personally do think that there is a case for symmetrical instruments, which are state contingent, and which basically provide automatic debt relief to countries when they need it, and provide investors with greater payments, with larger payments in times of an economic boom.
Thank you. I think Marcin had a comment to come in on that point around state contingent debt.
Well, a little bit more general than this. I think trying to link what Julia and Christian said, I think indeed the anchor provided by the multilateral lenders at the time, the uncertainty was so big that the private sector actually was considering what the outcome would be, and we all run mutual funds. So this is also something that needs to be taken into perspective, was very important. I think what is important now is that there are variety of funding options, that being the multilateral lenders, that being the capital markets being open, that being new potential investors. And I think that links to the ESG story very well, because indeed there would be new type of investors arising or being interested in emerging market if we will indeed overcome this challenge of a low starting point and some deficiencies in these countries. So if we all as an industry will promote the direction of travel approach to emerging market, more inclusive look, more holistic look, and also we work together with the issuers, for example, on green bonds, sustainability bonds. So we already know that the starting point will be very difficult. So in a kind of very harsh screening, some of these countries may indeed fall out of the scope and will be prevented to raise the capital they need so badly, and then to meet the SDGs, etc. So we need to work with these countries that the frameworks they use are robust enough to go through this process of screening, whether this is a greenwashing risk, etc. And I think this is our contribution to this. And that will promote all the new instruments, which will indeed make this stock of debt that we accumulated as an emerging market worth 10 percentage points more debt to GDP over the corona crisis. It will make it more sustainable because there would be more funding sources. And clearly we need growth to support this whole sustainability story. So vaccination, that would be very important. It does feel like this divergence between DM and EM is just peaking. And then as we progress more in the developed world, more vaccination will become available to the emerging market. But this is certainly something we need to observe, because the longer we have the bottlenecks, let's say the higher inflation in these countries will be, let's say the more moving to local funding, which I think is very advisable, and I agree fully with Christian that makes them less vulnerable. But of course, the higher inflation will push that cost higher as well. So that's something that needs to be taken in parallel.
Thank you, Marcin. And maybe to get Yerlan's thoughts on this as well.
Yeah, if I were just to add to the commentary, I believe that where the private sector and public sector could meet is actually at the situations that are already in the market, where restructurings do happen and are happening and will continue happening. So maybe public sector has been, instead of public sector criticizing the private sector for not taking more active part in DSSI, it's probably time for us to sit down with the public sector and to discuss the framework that they could really help us with while we're restructuring the debt of countries, where we can really do two things. Something that Julia mentioned, we can really go and explore again partial guarantees where multilateral organizations can provide us with credit enhancement, and B, also on the green tagging, the budgetary expenditures towards exactly those goals that we all share with governments and also multilateral. So I think this is going to be an important juncture because ultimately the private sector is ill-equipped to participate in debt relief in its puristic form. And in reality, what happens is a debt relief that is given by the private sector is done through the restructuring processes. Why not to use that market mechanism that has been there to really go and engage with the sovereigns at the time when they need us, and at the time when also multilaterals can step in instead of competing with us, or instead of overcrowding us in providing even more debt to these countries which can ill afford it. So I think this is going to be a very important point where we all have to come together and work on all of these points, new instruments, frameworks, and also insurance, as Christian mentioned, that it would be a great idea to create a mechanism against the pandemic such as we had, like we did already with catastrophe bonds.
So out of a crisis, lots of avenues for trying to do things differently the next time, and perhaps that much earlier coordination between all of the different actors. Perhaps looking back at the COVID crisis, what everyone's abiding sense will be was maybe the multilateral response and the private sector response came together in the end, but it would have been so much more beneficial had it happened even earlier.
Yeah, we can share some positive experiences with that. We were working during the restructuring processes in Argentina, in Ecuador. We were working with multilaterals. We were working with governments on formulating the KPIs for the sustainability linked elements in the restructuring process, and we continue working on those now in the restructuring process of province of Buenos Aires, for example. So we can see that there's definitely a significant interest in multilaterals of supporting such a framework. So it's glass half full, as Martin says here. So we're already now seeing that acceptance that this could be a market-driven mechanism where both private and public sectors could work together.
Thank you. We've got about Julia.
So I was just going to jump in, but to really highlight Erland's point here, I think that's really key. We've seen multilaterals providing for decades capacity building. It's been a set of really much needed interventions. I've experienced that in my career in Nigeria, for example, in the civil service there. It is very much part and parcel of the assistance that multilaterals can provide above and beyond the financial package. It's really the technical assistance package. It has been key for the work with public sector and institutions so far. Where they can see the next leg up going forward is probably what Erland was saying just now, the link between public sector institutions and investors. And to be fair to them, we're seeing a lot more activity, for example, on the part of the World Bank Treasury in coming through with tools on ESG investing, in approaching as a user proceeds bonds for DMOs in developing countries. So they are stepping up their game. It's great to see. And I think that's an avenue they could definitely pursue to really bind together these two parties in the game, the public sector, the countries, as well as investors and the private sector on the other.
Maybe just one thought to add to that, what Julia just said. One example of that is the recent issue by the West African Development Bank, Banque West Africaine du Développement, which issued a bond that invests in SMEs in the Sahel country, in women empowerment, in a lot of very sensible projects, and issues that bond at mid-swaps plus 300 in euros. So extremely attractive for us, and only made possible because we have a control of the use of proceeds by those multilateral agencies.
Martin?
One sentence comment from my side. It's great to see all these new instruments and initiatives. And I know that there is a competing capital providers in that. But I think what I'm missing so far from all these frameworks is more strict approach to transparency. And I think that was one of the assumptions around the common framework. So far, we have not seen much of it. And for all these funding sources, including us providing the capital, we need transparency for this whole sum to actually work. Otherwise, it will be kind of a bit of a prisoner dilemma, and it would be very regretful.
Thank you. We've now come up to the end of the 45 minutes allocated, but I think we've had a very good discussion around the way forward and the key takeaways from this session. It's not just about the threats posed by the divergent economic recovery. Economic growth will return to emerging markets. There's plenty more to be done in terms of channeling capital that much more usefully to the locations that need them the most. So thank you to the excellent panel that we've had today. I'm sure there were many, many more questions that we didn't get to. On behalf of Standard Chartered, I'd like to thank you all for your time. Sadly, we've come to the end of this session. Thank you all.